Bitcoin crashing to $8,000. Just hearing that number sounds insane. But recently, one company forced the entire crypto market to think about it seriously. Because during an earnings discussion, the CEO of Strategy, the company formerly known as MicroStrategy, revealed something that immediately sent shockwaves through crypto. He said Bitcoin would need to collapse all the way to around $8,000 before the company reached a true critical failure point on its debt. Now on the surface, that sounds reassuring. After all, Bitcoin is nowhere near those levels. But underneath that statement was something much more important. One of the biggest Bitcoin holders in the world is underwater. And they're not alone. Right now, an entire sector of companies that borrowed money to buy crypto is facing its biggest stress test ever. If this model breaks, the consequences could hit the entire market. So today we're breaking down what's really happening behind the scenes. Why corporate crypto treasuries are suddenly under pressure, and whether this could trigger the next major crypto collapse. Welcome to Web3 Verse, the company that changed Bitcoin forever. To understand this story, we need to talk about strategy. Years ago, the company made one of the boldest moves in financial history. Instead of holding cash reserves like a normal corporation, they started buying Bitcoin aggressively. At first, people thought it was insane. But as Bitcoin exploded higher during the bull market, Strategy became legendary. Its stock surged, its Bitcoin stack exploded in value, and suddenly, other companies wanted to copy the model. Fast forward to today, and Strategy holds one of the largest Bitcoin reserves on Earth. Hundreds of thousands of BTC. A position so massive that the company effectively became a leveraged Bitcoin holding vehicle. But here's the problem. Most of those purchases happened at much higher prices. And now Bitcoin has fallen below their average entry, meaning the company is officially underwater on paper. That's the part many people aren't talking about enough. The $8,000 number. Now let's clear something up immediately. The $8,000 figure does not mean Strategy gets liquidated at $8,000. This is not like a leveraged futures position on an exchange. Nobody can automatically force them to sell their Bitcoin tomorrow if the market dips. That's because most of their debt structure works differently. The company raised billions through convertible notes and long-term financing. In simple terms, they borrowed money from investors with the promise that those investors could later convert that debt into company shares. That structure gives Strategy more flexibility than typical leverage traders. But it also creates another type of risk. Because debt always comes with obligations, interest payments, refinancing pressure, maturity deadlines, and eventually, those obligations arrive. Why time is the real threat? The biggest danger for Strategy isn't a sudden liquidation. It's a prolonged bear market. Because if Bitcoin stays weak for years, things become more complicated. At some point, investors holding Strategy's debt may want repayment. And if the company's stock price is struggling, raising fresh capital becomes harder. That means Strategy could eventually face difficult choices. Issue more shares and heavily dilute investors. Or potentially sell some Bitcoin to raise cash. Now to be clear, they still have substantial reserves and runway. This is not an immediate collapse scenario, but it does expose something important. Even the strongest Bitcoin treasury company is not immune to pressure. And if Strategy is feeling pressure, smaller copycats are probably feeling much worse. The copycat explosion. Here's what happened during the last bull cycle. As Strategy's stock exploded higher, corporate executives everywhere saw an opportunity. Suddenly, every company wanted a crypto treasury strategy. Some bought Bitcoin. Others bought Ethereum. Some even pivoted their entire businesses around digital assets. And during the mania, look genius, stocks pumped overnight. Retail investors piled in. Companies raised huge amounts of capital. But many of these businesses weren't built like Strategy. They didn't have massive balance sheets. They didn't have deep cash reserves. And many didn't even have profitable businesses outside crypto. They were essentially leveraged bets on digital assets, which becomes extremely dangerous in a bear market. The Ethereum treasury problem. One of the biggest examples is what happened with companies heavily exposed to Ethereum. Several firms accumulated massive ETH reserves during peak optimism, but many of them bought near the highs. Now prices have cooled dramatically, and suddenly billions of dollars in unrealized losses are sitting on corporate balance sheets. That creates a dangerous cycle. Because once asset values fall, the company itself becomes weaker. Its stock falls. Its ability to raise money weakens. Investor confidence disappears. And eventually, the market starts questioning whether the entire model works at all. Why smart money is getting nervous? Now here's where things become more interesting. Some major investors have already started exiting these treasury plays. And when sophisticated capital leaves first, markets pay attention. Because smart money understands something retail investors often ignore. Leverage works both ways. During bull markets, leverage accelerates gains. During bear markets, it accelerates destruction. And that's exactly what many analysts are worried about now. Not necessarily Bitcoin itself, but the companies built around leveraged crypto exposure. The real systemic risk. This is where the conversation shifts from individual companies to the entire crypto market. Because these treasury firms created two major forces inside Bitcoin: demand pressure and potential supply pressure. Let's start with demand. Over the past few years, these companies became massive buyers of Bitcoin. Some purchased thousands of coins every single month. That constant buying helped support price. But what happens if they stop buying? Suddenly one of the market's biggest demand sources disappears. Now combine that with the second risk: forced selling. Because if smaller treasury companies run into financial trouble, they may eventually need liquidity. And when companies desperately need cash, they sell assets. That's how contagion begins. The domino effect. This is the nightmare scenario analysts worry about. Prices fall. Corporate balance sheets weaken. Stock prices collapse. Debt pressure rises. Companies start selling Bitcoin. That selling pushes prices lower, which creates even more pressure on other companies. And suddenly you get a cascading feedback loop. We've seen versions of this before. Luna, Three Arrows Capital, FTX. Different structures. Same psychology. Once forced selling begins, markets move violently. Because forced sellers don't care about support levels. They sell because survival becomes more important than timing. Signs of stress are already appearing. Now we're already seeing subtle warning signs. Some major firms have reportedly moved Bitcoin toward exchanges. Now that doesn't automatically mean they're selling, but it usually means they want flexibility, optionality, the ability to raise liquidity quickly if conditions worsen. And that's exactly what markets are watching right now. Not panic, but stress. The big question: could Bitcoin really hit $8,000? Honestly, probably not. And here's why. At those levels, the economics of Bitcoin itself start breaking down. Mining would become deeply unprofitable across huge parts of the network. Institutional buyers would likely step in aggressively long before then. Remember, today's market is very different from previous cycles. You now have ETFs, institutional funds, sovereign exposure, long-term allocators. These are not traders using 100x leverage. These are entities thinking in decade-long time frames, which creates a much stronger structural foundation beneath Bitcoin than many people realize. What's actually happening? So what are we really seeing? Most likely, a cleanup phase. The corporate treasury model itself probably isn't dead, but the reckless version of it might be. Because during the bull market, almost anyone could buy crypto and watch their stock pump. That environment created excess. Weak companies, bad debt structures, over-leveraged balance sheets, and bear markets expose those weaknesses brutally. That's how markets reset. The strongest survive, the weakest disappear. And honestly, that process may actually make the ecosystem healthier long-term. The difference between strategy and everyone else. This is the key distinction. Strategy prepared for volatility. Their entire identity revolves around surviving Bitcoin cycles. But many copycats entered the trade because it was fashionable. They treated crypto exposure like a shortcut to stock market hype. And now they're learning the hard lesson. Holding volatile assets with borrowed money becomes very dangerous when markets reverse. That's why some treasury companies may disappear entirely over the next few years. Not because Bitcoin failed, but because their structures weren't built for survival. Final thoughts. Right now, crypto is entering a very important phase. The easy money era is fading. Speculation alone isn't enough anymore. Now markets are testing balance sheets, debt structures, liquidity, and long-term conviction. The companies that survive this period could become giants in the next cycle. The ones that don't will become cautionary tales. And honestly, that's how every financial revolution evolves. Excess comes first, then collapse, then consolidation, then maturity. So no, Bitcoin probably isn't going to $8,000. But that doesn't mean there's no danger. Because even if Bitcoin survives, not every company built around it will. And that distinction matters more than most people realize. So now I want to hear from you. Do you think the corporate Bitcoin treasury model is genius? Or do you think it's a ticking time bomb waiting to explode? Drop your thoughts in the comments below. And if you want to understand who's actually buying Bitcoin during this market weakness, check out the next video. This is Web3 Verse. And I'll see you in the next one.